Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, streaming live from Ticket Talker. Let's take a look at the gold market. Last 1843.20. We've been pretty much all over the place here with the gold. It seems we have resistance showing us at about 1849 here early this morning. And we came down to the average price for the day, which is 1840. And we saw this huge buy-in interest develop from the average price, activating a bullish trend momentum and surging right through the sell one target, completing it, and not quite getting up to 1859, which is the sell two level for today, and reverted right back down through the sell one target, activating actually a short trigger reversal. And the market reverted right down almost into the first target of 1840. We're seeing a lot of volatility here in the market as we approach this red levels up here. For most of my traders by now know that the red levels, as they start to identify the red levels here from the daily at 1849 to 1859, and the weekly sell one weekly level is at 1866, right above it, and right above it is 1874, which is the monthly level, the monthly average price. Now, what this means, basically, automatically, even before we get up here, the algorithm tells us that the red levels are distribution levels of supply. And mathematically, it is the extreme level above the mean with a 50 to 90, 50 to 95 standard deviation relative to the mean, the relative implied volatility to the mean. And mathematically, basically, using this probability model, it tells us that the market above 1849 all the way up to 1874 is resistance, what most conventional technicians would call this resistance. And so when the average price activates a bullish trend momentum, the targets are right above it, and that's 1849 as we come in today. And we can see the market chopping above that resistance level. And finally, after coming back down again and testing the average to see where, if we have identified more buying in the market, we see that the market came right below the average of 1840 and then reverted with a vengeance, moving right into the target of 1849 daily and not quite getting up to 1859. The high so far was 1856.60. And that is where the market confirmed sellers, in fact, showed up to overtake the demand below and revert the market down to the support level that became resistance now once it went through 1849. The algorithm, when it goes through the resistance level, it becomes the support for the next fractal in price. When it comes down, it negates that, and a close below activates again a bearish trigger. Remember that the mathematical probabilities that the VCPMI identifies up here, it's telling you this is a 90% probability that if the market does not follow through, identifies the sellers, comes down to close below, you're getting a 90% probability of a reversion to unfold. And that's what's happening right now. And the initial target is 1840. If we take a look at the silver market, down about 6 cents, we pretty much saw the same kind of situation here, that actually, when I saw this little descending channel here, and I thought the market breaking above it here would at least take us to 27.77, but it did not. It found sellers at about 27.60. It reverted the market back down under the average price. It negated the previous bullishness, and now it's activating 27.02. It's in a short bearish price trend momentum. And unless it goes back about 27.45, it has created, again, a bearish trend momentum. So we have a bearish trend momentum in silver, and a short trigger has been activated on the daily signal with a target of 1840. We have some of the derivatives like Nugget up on this move up, obviously making a high of 66.97. But it's a quiet market across the board, pretty much. With what I believe is a bit of a bearish tendency, based on the fact that we are rejecting this price levels here in 1856.60. There's a slew of indicators up here that indicate that unless the gold market has the muscle and the strength to close above 1874, the reversion or the extreme below the weekly mean is all the way down to 1775. The extreme below the mean on the weekly. The daily, the extreme below the mean is all the way down to 1820. if we close below 1840. And 1820 comes very close to the annual target of 1810. So as I interpret the AI of this incredible trading tool here from a personal application, and this is what I suggested my traders, this is what I believe the last couple of days the market gave us the opportunity is to hedge up here. And when the market gets into these red zones, particularly as they approach the weekly or the monthly pivot points, it creates what it's called a harmonic alignment. And so what we have here is that we're getting, again, the AI is telling us the levels from 1849 all the way to 1874 are levels that offer a high probability that you could see sellers or supply come into the market. So if you have this information prospectively, obviously, and it's a question of, I think, confidence. I've been doing this, following the methodology here, at least for the last 15 years. And every time that I second guess it, it's proved me wrong. And so I've learned to respect the mathematical probabilities and use this as a guiding tool, as a GPS for my trading. And so what I'm basically looking at here is that I do have a core position. Long term, I'm very bullish. Long term, I have a core position. And I have hedged my core position synthetically so that if this resistance is taken out, and by the way, synthetically means that I'm using other derivatives against my long-term core position to give me some protection if the market is going to come down, or if I am wrong and the market explodes through this resistance level, that I'm not going to miss the move. I am long, synthetically long. And I would be very much interested to see if we get this reversion unfolding, which is a counter trend, actually, move that would happen, a swing move back to the extreme below the mean. I probably would get aggressive at that point. In accumulating additional long-term bullish core positions in metals and covering any hedges, any short strategies short term. If you took the short trigger by now, if you've been with me, and if you've been in my trading room, obviously this is what I teach and coach, is the application and the implementation of the signal when it is identified. And if you entered into the signal, you can trail the position if you want to with a stop, depending upon the multiples that you have. Or if you have one contract, just trail when it begins to work for you to your entry point. initially, or and if you want to keep it until the next target, which basically is the 1840. For this trade, for this day trade, it is short at 46.80. The target is 1840. Let's watch the market here. Let's watch the signal. Follow the signal. If you are following the signal in a live account, use the trailing stop at this point to lock in your profits. Usually, if I do multiple positions, I lock in the first $300. So if you did multiple positions, you got a chance to lock in. Go flat, go flat, go flat, go flat, go flat to gold. Take your profits. 1844.50 out. And so that's about a $300 move that we just locked in. And we are flat. We've taken the profit. I've recommended basically to take the profit and go flat. Now, this is a fast trade that we saw earlier this morning. And this is pretty much how quick it can happen if you're day trading. And even though the signal is still short, what we're doing here is I'm showing you how to manage the profits. Besides basically the signal that was given, what I am doing is I use the first $300 as a target. I mean, and even if you have five contracts, let's say, and you're looking at a $1,500 move if you're using multiples. If you want to scale out of the trade, then you again can use the trailing stop or put your stop again at 1849 and a close above. That would be the place to get out. So that was a quick, $300 stop that I decided that I want to take as a trader. And this doesn't change my view of the market long term. The fundamental picture still very supportive of prices long term. But we are getting this kind of volatility where, it provides trading opportunities. And I'm showing you how to use the VCPMI to identify those trading opportunities. And you don't need a real busy chart as I'm showing you here. I am taking the signals pretty much as if I was a robot. The code was written in C++, easy language, and coded in TradeStation. So this is an automated program, and what I'm doing here is I'm showing you reversing engineering the AI that tells the robot exactly what I'm doing here. And that's what's called systematic trading, methodical trading. I haven't looked at anything at all except what this signal is telling me in this live streaming presentation, which I'm trading live. And so if you take a look at, the 260 episodes that I've done live trading, in all those episodes, I've captured essentially the trades that generated in excess of $1 million for me last year, which is documented on my website and also documented in this live streaming presentations. I think it's important in the essence of what's happening in the marketplace. Kind of really now confirms what I basically my mission, why I wanted to do this. And I feel very fortunate, first of all, that I'm doing what I'm doing, and I've had the luxury to be in this business for such a long time. It's a privilege. It's been a challenging business. It is a challenging business. And what I've learned basically is to make it work, and some of the elements that I have found that work for me as a trader and are working for other traders that are doing phenomenal here. We just completed the target of 1840. Target completed. So now the signal goes neutral. That's it. You're out. You let the market do what it's going to do. And we've completed the target for the day trade. So from 46.80 to 40, that's a $680 trade that we just materialized in a live trading account in live streaming here in TikTok. You can't get any more real than this, regardless of what I do or how much money I make, or you are seeing the actual validity of the algorithm. Whether this is a simulated platform or not, it's irrelevant to you. What you want to know is that if you sold at 46.80 as the signal validated, that you took out $680 profit right in front of your eyes. So now that we have traded below the average price, the trend momentum is bearish, and it has negated the previous bullish trend momentum. What we're seeing now is the momentum unfolding to a bearish momentum, and the target 1830 now is in place. This is the first level of the extreme below the mean of 1840 on the daily. And right underneath, we have the weekly 1825, 1820 daily, and the annual average of 1810. So in the same way that I showed you up here, the red levels indicate the market tells us when you get up here, you can possibly and potentially see seller supply come into the market. And, when you see this kind of synergy, it's amazing how accurate this is. And the only reason is because it is a mathematical algorithm, a probability algorithm. Mathematically, it's got nothing to do with the fundamentals of the market, which are irrelevant at this point. The fundamentals are already factored in the market. And the market is telling you it's having a real hard time getting through this resistance level, this sellers here, even though we have such fundamental bullish news. And so this tells you, ahead of the sentiment of the market start unloading here, taking profits, hedging synthetically, cover the longs until the market comes down, ideally below the extreme, below the mean. And the market will dictate that. Only the market will dictate that. But the algorithm tells you the landscape and the targets in place and the color that it is, so that you can psychologically prepare yourself prospectively, particularly if you applied the short trigger that was given. Or not, you don't need to do anything. If you have a long core position, if you're a long-term investor in the gold market, you don't need to do anything except buy and add and corrections. What I'm doing here is showing you how I, as a trader, for day trading purposes, I apply the VCPMI. And for those that are interested in that kind of intelligence, obviously, you came to the right place. But you can also use this for swing and for position trading, obviously, as I'm sharing with you my long-term core position is bullish. The alternative count to this intelligence is that unless we get through this wall of resistance and close above 1874, the possibility is becoming more probable, particularly if we close below 1840, that we can test the extreme levels below the mean, below this average price, again, which are into that 1830, 1820 level. I think we can expect, again, tremendous volatility here. As you can see, the market in silver came down right into the support now of this descending channel here, and right into the buy one level on the daily. So now it looks like the market in silver almost came down to the buy one level of 2702 daily. The low was 2703.50, and boom, 2721. Reverted right back up. It found the buyers right here, you see. This is what finding buyers does to the chart, to the momentum, and it's telling us it came right into where it's supposed to revert. On the daily, the target is 2745 for this move here between the buy one and the silver. So, I just want to for those that are trading in the futures contracts in the metals here, the volatility that you're looking at is by far just historic. And it's broken, really, like I say, the benchmark of any previous volatility that we've used to seeing in these markets. And we get, it's just the beginning. It's just the beginning, so just trade according to your profile and make sure that you don't overposition yourself, regardless of how great the position looks. Find a mean in your trading in order to stay alive. And that's essentially, preserving your capital and managing your risk intelligently. And this is what the VCPMI does. It helps you to do that. In terms of the obviously money management aspect of the account, that's again according to your profile, how you manage the risk of the instrument that you want to trade, where you apply the VCPMI. The bigger pattern, in terms of the market here, which is what I think is unfolding here, is that according to Elliott wave principles, this is the completion of what it's called the fourth wave. And it's a corrective wave. The completion of this pattern, according to Elliott wave, is 5 counts, 5-way patterns. And that 5-way pattern points to testing this previous low here that we saw of 1784.60. Unless, the market validates upon testing, let's say, the annual, once again, the annual mean of 1810, it reverts back. And so that's a possibility. But we have what seems to be reverting from, again, this red zone up here that you see, a wall of resistance. And I am looking for a reversion, again, to test this blue level. Ideally, the annual 1810 before the completion of this move. I think that once this wave pattern is completed and we come down and we test the extreme levels below the mean, we should see a very, very robust rally into possibly the middle of you're looking at where the 15th here. It looks like the market is calling for some kind of a short-term counter trend wave count top, and the completion of that pattern is at about 1781 to 1775. This confirms and validates again what the code is looking for. And this not only validates that, but it tells you exactly the price, not just in general a range, so you might say. And with the market coming down to these prices is what's going to validate the signal. So the market will do the work for us. The code will tell us where we can expect that to happen. The 1874 is a formidable pivot level that is very indicative of the power of the demand behind it, that would be able to take the market above that and pretty much right above that, there is hardly anything. As you can see, it's pretty much air. So if there is enough strength to take this market out through 1874, there's a very good chance, that it can precipitate an acceleration all the way up to 1917. But that is a big if, and only the market, again, is going to confirm that. So far, we following the day trade signals here, we took a profit here. We were neutral. And we're just waiting now for the market to activate the next highest probability signal above or below the mean. What it tells you here, again, when you're trading around the mean, it's going to get choppy. So just go neutral, take your profits, and wait for the highest probability trade. As you can see here, trading around the mean is choppy always, above or below, until it unfolds into the extreme target above or below with the highest probability, and then the reversion unfolds. You see, this is the reversion that brought the market down to its mean, that brought the longs or the buyers to its knees, so to speak, by bringing it down to the average. And, all I do here is, as I keep saying, is I use the basic law of economics of supply and demand. And this is pretty much what I look to trade. Once again, with regards to the fundamentals, I think the fundamentals that are being discussed right now by our administration and even some of our world leaders and central bankers here regarding the state of the world economy as a consequence of the pandemic are pretty much factored into the price. And pointing case, even though we had this Reddit raid in the GameStop stocks or some of the heavily shorted stocks, had a real short-term impact in the silver market. But it's not over. That is just a sign of things to come. And I think the market is regrouping. The players are regrouping, realizing that we do have potentially an explosive situation developing here in the silver market because we are running out of supplies. And the only way that you can get supplies right now is really by waiting for a long time and paying up a very, very high premium. So the fear, you might say, that we have on the short end of those players, you might say, that are looking for prices to be capped, which are primarily the industrial users, major money behind this short positions, basically, that eventually do affect the bottom line and expenditures of a lot of these technology companies, Apple, NVIDIA, all these companies that are creating technology chips, they use silver tremendously. Now that we're moving into a more climate conscious society, so to speak, or climate control, solar panels are pretty much in demand, and in that kind of industry, silver is being used tremendously. And so the application of silver from an industrial demand level is getting to a point where, if potentially this physical tightness that we have in the cash market, which is reminiscent of what we had back in March of last year, will eventually invert the spot market, as you saw last year, where we saw an $80 move, in the cash market against the paper market. I mean, you could sell the futures markets, but you couldn't get physical. And so it put this short players, the short body of central bankers that are constantly shorting silver in particular, which is the thinnest market. It's the most undervalued asset across the board, but it is thinly traded. So they can manipulate the market. They can move the price like a wet rag. And, sometimes the price movement, like it is right now, for example, under this fundamental scenario that we have, which is extremely, extremely inflationary with regards to monetary policy, the silver market begins to kind of fit into now the dimension as an economic indicator. It's poor man's gold. It's the cheapest precious metals that anybody can buy. But it is also the most volatile. And again, it's for the benefit of the industry that the price of silver is manipulated. And so what you want to do is, if you want to measure the pulse, you might say, of that demand, you want to keep an eye on the 1,000-ounce bars that are primarily used for industrial use. And if we run into a tight supply situation in 1,000-ounce silver bars, that's going to be a confirmation that industrial demand is getting panicked, getting scared of not having the silver available to produce all these products. And I believe that's when we're going to see the shift in paradigm in the silver market, that we could see a $50 price adjusted really fast. Talking about volatility, the silver market is one of the most volatile markets on the board, besides pork bellies or lumber. And so it is a cousin of the gold market in terms of precious metals. And in fact, that relationship alone, using the gold and silver ratio, which I believe is around in the 60s, benefits the price of silver still to be tremendously undervalued to the price of gold. Recently we saw that spread ratio get to about 120 here as the price of silver collapsed in March of 2020. And since then, we've seen already a 50% drop in silver, obviously traded 30, from the 12-ish area in that vicinity. And I believe this is just the beginning of this move in the precious metals markets here. But you have to trade the market, particularly in precious metals, from a technical point of view primarily. As you can see, the fundamentals are not affecting the market, because based on the fundamentals that we have, the prices should be skyrocketing. Instead, the central bankers continue to pressure the price of gold and silver. And as you can see, we're now coming down possibly to that buy one level of 1830, which would be fantastic opportunity, because I'll take a look once upon the confirmation of the market. Then I can decide whether I want to cover my short hedges that I have. I sold some calls way out of the money, and it seems that was the right thing to do, as the code was indicating again that the area in red is distribution of supply. Things got a bit quiet here. Let's take a look at the trade station here platform. The VCPMI covers more than 80 markets for us, which provide the daily algorithm that you see here, and the AI tells us pretty much, how to apply it. Now, as a trader, I can't trade 80 markets, to be honest with you. It's impossible. So I choose to trade the most active ones, the most liquid ones, and that's gold, silver, the mini, and Bitcoin, which is an interesting market here that has developed. And we use it to trade actively through the Grayscale Bitcoin Investment Trust. And we saw a high here, 49.03 this morning, and I think this there's a huge gap in here, and it looks like the market might have been a little overbought. The high was made at 49.03 yesterday, and we're getting a bearish reversal from that high. So we're interested in letting the market come down into these blue levels, which are the accumulation of demand, in order to get on the long side. The bottom of this descending channel here is at 1781, and that's what's being activated. If it closes below 1810, that's the annual mean. Actually, the monthly mean of 1874 activated 1781. That now the market is going to confirm or validate that. It doesn't, again, when we identify these numbers, it's not a guarantee that the market is going to do that. Only the market knows where it wants to go. What this does is it gives us a mathematical, probability that this is where the market potentially is going to react to, or we can expect a reversion or reaction to occur. So this takes me out of the emotional realm of second guessing where the market is going. But it gives me, again, a pretty clear landscape with very specific targets and levels to expect. 2705 on silver. 2706. That's completing some targets here. Short term, we are activating a buy signal here on silver. We came down to a low of 26.88, and now we reverted right back up. And so 2702 is activating a buy signal here on a close at 8 o'clock in 9 minutes. That would be a very strong conservative signal to get long on silver if you want to day trade the market. You can measure the entry point that defines for you the risk-reward ratio. The closer that the market closes to this pivot point of 2702, obviously the lower the risk. But if it does move or close higher than, $300 or $500, then I just pass on the signal, and I wait for the next opportunity. So I don't chase the market. I don't recommend anybody to chase the market. We're, again, the conservative signal is activating potentially a buy on a close above 2702. But if it closes too much higher than that, you may want to pass on the signal conservatively. The aggressive bought the opening at 26.92. The aggressive signal after the market has tested the previous signal, if it comes down and reverts right back up to close above it on the close of the next bar, conservatively or aggressively at the opening of this bar, can activate a long position. So we want to take in our profits here that we have on silver and day trading here, and we locked in about $4,835 on the short side, and we're waiting now to see the signal if it's going to give us a buy signal above 2702 with a reasonable risk reward ratio. Right now, we're holding on to our core long positions and continue to trade the market from the long side. And if we get up to, again, the red levels above 2776, as you can see here, the market activated a short trigger, and now it's completed the extreme below the mean. The weekly algorithm will be completed at 25.20, the target, 25.20. So we still are in a bearish weekly mode. We still are in a bearish daily mode. And we've completed our first target of 27.02. The next target is 26.70. And the next target after that is 25.20 on the downside. The gold market is trading under the daily average of 1840, and unless it closes above 1840, then the 1830 is activated. And I think what we're looking at right now is pretty much the silver market leading the way. On this move up. 27.11, obviously, 27.11 and a half is going to be the close into this hour. So as far as the conservative signal, obviously, I would recommend not to take it. If you took the aggressive one, you know your targets are 27.45 and your stop could be 27.02. We got some good buying here. Short term, the target is 27.45. Continue to hold your long-term bullish position, and I look forward and see you next time. Thank you again for the opportunity to share this with you, and until next time, my friends, please take care of yourself. Be careful. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
And welcome to another edition of the Ticker Talker Spotlight here on Ticker Talker TV. I'm Bill Barry, Global Head of Business Development for Ticker Talker. With me today, Mr. Patrick MontesDeOca. Patrick, I hope I didn't butcher that too badly.
You did well. Thank you.
Thank you. I appreciate that.